You can do slow flips anywhere as long as you can find a buyer that can pay the rate in order to see the kind of return that you're looking for.
All right. Good day, everyone. Thanks for joining us on this purpose-driven investment podcast. I'm your host, Shinyi Telscher. This is the episode that we learn from each other, talk strategy, and create returns that matter. So today I have my dear friend Ed Jones joining me today. I'm super excited. He's a local real estate investor who's currently based in Southeast Massachusetts. But I was sitting down with him having a breakfast a couple months ago, and I was just eavesdropping, and I learned this term called slow flip. I was super intrigued, then have a conversation with him. I was super excited having come on to talk about what is a slow flip. So how are you doing, Ed? Thank you for joining us today.
I am doing fantastic, Shinyi. Thank you so much for inviting me on your podcast today.
How did you start in real estate?
I graduated from MIT, so I was trained as an engineer many, many years ago. However, my background is primarily in computers. I own an IT services company for over 20 years and providing technical support to businesses in the greater Boston area. And about 5 years ago, I said, well, it's been a long time I've been doing this. I'd like to do something different. I'm very entrepreneurial. I went directly from college right over into starting my own businesses. I had options to do like the corporate route, but I said, let me try to do this entrepreneurial thing. 5 years ago, I decided I wanted to do real estate. So I started poking around and started getting involved with different aspects of real estate. A couple of years ago, I ran into Pace Morby and the whole Sub-2 community, and my life completely changed. I learned how to do creative real estate and be able to get in different kinds of ways that didn't involve traditional lending. I did some fix and flips. I also did other types of investing. I've done Sub-2 types of agreements. I got a couple of rentals. And then I found this one method, which just once I had it, it was just, okay, this is it. This is where I really want to focus on. And that's called slow flipping. And now it's a creative strategy. Probably 9 out of every 10 investors never have heard of it. It's a really powerful investment. It can create some tremendous returns and also allows even people who are relatively newbies to be able to get in and see some great returns. And let me tell you a little bit about it. It's not like traditional flipping. It's a different kind of strategy. Basically, it's a cash flow play. Now, with slow flipping, you're purchasing properties for cash, and then you're reselling them immediately right after purchasing them using a contract for deed, sort of like an installment sale. So if you've ever bought a car or you financed a car, it's the exact same thing where over time, you'll pay off that particular vehicle and then you get the title for the vehicle. Imagine doing the same thing for a house. We set up that same kind of installment sale contract and then they pay it off over time. Now, what makes slow flipping different, there's a couple of things. First is the price point. It works best when you're dealing with very low cost properties. It's in certain markets, but the best returns happen when it's really low cost. You can really do this anywhere. You can always take a property that you own and then turn around and resell it via contract for deed. That's what most wrap buyers do. So, and it's very similar to a wrap. But it's a little bit different in the sense that when you buy it really inexpensively, and you have properties that are in the Midwest and the South where you can literally get properties for less than $50,000, you're thinking, okay, that's not possible. These are properties that are totally livable. Many of them are even rent ready that you can get for a really, really low cost. And I can give you a quick example. So let's say, for example, I bought a property. It was a 4-bedroom, 2-bathroom house, and it had a 1-bedroom apartment in the garage. Nothing really wrong with the property. It just needed to clean out, minor repairs here and there. The 1-bedroom apartment was actually only like 2 years old. I bought that property for only $39,000.
$39,000?
I turned around and resold that same property. And here's the second thing that you do with the slow flip. You buy them rent ready or something close to it, at least livable, where there's only minor cosmetic things, paint, flooring, minor carpentry repairs. And this one fell into that category. I turned around and resold that property for $99,500. Didn't do a single thing to the property.
Not even clean out? You do?
Shinyi, I didn't clean the property out. Left furniture. I told him to leave whatever he didn't want to have and we'll just take care of it. He left furniture. He even left some food in the kitchen. There are tons of properties that fall into that category. There are major parts of this country, and it's not all like C, D class neighborhoods either. I'm talking just particularly in the Midwest where incomes have not gone up for decades, where manufacturing left those areas decades ago. A lot of the top jobs moved out of those areas where people's incomes didn't go up. And consequently, the housing prices didn't go up either.
I see.
So mean house prices are like close to 100,000, maybe just slightly higher. I mean, full on market retail pricing that's less than 150 throughout those areas. But these houses where you have mildly distressed, cosmetic issues largely are just sitting. So the sellers just have to sell them at tremendous discounts because the ARVs are so low. So to have somebody have to go in and have to do a lot of different repairs on these properties in order to get it to the full retail value, there's not enough margin there for it.
Not enough spread, yes. To do
Exactly. So there's no pressure for anyone to go in to sell it at a higher price. Everything just says, okay, get it at a discount. So you can get these properties for steals. I mean, less than $30,000 even. Properties where you can have somebody that wants to move in. Now, on the flip side of that, from the buyer standpoint, you have a lot of people who are starting out, who are renters, who are penalty box buyers, who where they may have like a 1099 and they can't qualify for traditional mortgage. They typically will just fall into the rent game and then just be giving money away every month to a landlord. With this method, this allows them a path to ownership. So that same property that I sold for $99,500, I sold it to a young couple, $3,000 down and only $1,070 a month.
Ooh, I like it how you make it easier entry for them, like low down payment. So I see a lot of people playing the level of like when you ask them to put on a lower down payment, you also have to carry a little bit higher risk. And like, what if they default and give the house back to you? But I can see that if that house value is not that high to begin with, so you're not really have the same risk.
Right. And you have to have a little bit of a mindset change when you're thinking about this, because normally you think of the house as the asset. So you want to make sure that the house is taken care of. Everything is perfect. If they make any damage to it, you want to hold them to it. So you got to have enough of a down payment. But think of it like this. The house was $39,000, right? And the monthly payment was like $1,070. So we were clearing after taxes and insurance for this about $969 per month. Now do the math. Let's round it off to $1,000. This is a 30-year contract. So it's not like a couple of years and then they're done. 30 years. So over 30 years, that's 360 payments of about $1,000 each. Do the math. How much is that contract worth?
It's gonna worth a lot more. You're amortizing over 30 years.
If you have a buyer who stays there without turnover, that's up to over $300,000 worth of payments for a house that you only got for $39,000. So the mindset change is the value is in the contract. It's not in the house.
Correct.
Play that out. Again, they stay in the house and go long term. You have a long-term cash stream. Within 4 years, your house is paid off. And then everything that is coming in is gravy. Now, they're buying the house, so therefore, no repairs, no upkeep. No one's calling you to do any, like to fix the leaky faucet or those types of things. They're taking care of all of that. Unexpected costs, they're taking care of all of that. So it's straight cash flow. Now, along with that, for them, it's still a boon because for their entry fee, they can get in and they can qualify really easily. And then once they start making those payments, they can build up their time. So refis, should they refi, as you pointed out, you get the equity bump and then the back end where you can get equity on the resale value. And then over time, you can build these and start stacking these properties up and then just create these revenue streams, long-term revenue streams once you either recapture your costs or, and this is, we can talk about another aspect of the slow flip, you can bring in individual private lenders.
Right. Because you buy in cash.
You're buying it cash. Exactly right. So with a purchase like this, you can bring in a private lender. And for these properties in that price range, we could offer 12% and then within 5 years, pay off their note completely. That's principal and interest, not just interest only. And there's no underlying debt. So once it's paid off, it's paid off.
So this is much safer to a lot of people trying to lend money as a RAG because they're second position. They're going to be lending money in the first position. Lender is buying cash. I like that. Yeah. So it further reduced the cost of you have to focus on somebody else. If they don't pay, you're the first position first to get paid. So talk us about how you structure your paperwork. Because a lot of time when the people come in as a private lender, right, they want to make sure everything's secure.
It would be just like a bank finance. So basically the private lender is a bank. So you get a promissory note in your you also have a mortgage. So it's tied directly to the house. It's first position. There's no other debt on the property, and it's secured by the house itself.
I see. If they're the bank, promissory note and deed of trust secure their lending, how the difference, like is there some sort of profit model is being split between the deal finder versus the private money lender?
So with the private money lender, just a single individual deal, it makes the most sense just to have them to be in a debt position where they're being paid off over that 5-year period so that they can move on. Now, with regards to the investor and myself in that type of deal, that first 5 years, there's not enough of a margin to make money during that period of time. So the focus is just to pay off that loan. And a little bit later, I'll share about a different method in which the private lenders can participate as well, but that's a different process.
I see. Is that castle project you're talking? I can see this could be a very good investment opportunity for certain people who are looking for more like a hands-off investment, but they have to be smart enough to underwrite. I always tell people, like, first, you only lend the money that you can afford to lose. And second, you have to know the number to underwrite to make sure this is a sound investment as much you can do from the due diligence space. So when you work with somebody, bring them into the lender, I'm sure you have your vetting process as well, right? You don't just take on anybody.
This is not for everybody. So there's a lot of lenders that are very much in the traditional flipping mindset. It's basically, I want my cash to go in, work, I get my thing, and get my money right back out within 12 months. This is not a fit for you. If that's your typical mode. The type of investors that we're looking for are people who are looking for more along the lines of passive investments over a longer period of time. So to create what they call mailbox money, so that you get a check that just shows up every month over a long period of time. Similarly, people who are investors who may be investing in things like multifamily, where there isn't an immediate return, where you're looking, further down the road, maybe years down the road in order to get your return. This also might be a good investment as far as being able to see monthly checks coming in versus quarterly or waiting to the very end in order to see your money come in. So those type of investors are more the type of investors that I'd be interested in sharing this with.
Well, once they put their money in, what does it look like, the communication? Because I'm sure they don't want to be bothered with like tenant call them about anything about the house there because they're in the lender role, right?
Now, remember, again, there's no repairs, there's no fix up, there's no random tenant calls. Basically, the idea is that we take the same positioning as a bank. So Bank of America doesn't fix toilets, right?
Yeah, no, they don't.
There's nothing that requires property management in the traditional sense. Now, as far as the investor is concerned, in the case of myself or somebody who's interested in employing this strategy, your primary thing is just making sure that once you fill the property, you acquire the property, you fill it, and then you just make sure that they continue to pay. So if they don't pay on time, then you have to do the notices, the late fees, or taking them even up to and including an eviction process. That would get them out of the property.
I see. Would you be compensated for this whole process, or maybe I think there's like different kind of profit sharing model for this whole collaboration?
Okay, so let me speak to specifically investors. There's 2 different profit sharing models that we can work with individual investors with. Actually 3. Number 1 is the one that I mentioned already, which is the debt, where you can just get regular debt payments. You have no interactions. It's totally passive. You don't have to be concerned about anything that's happening with the property. Even if the property is vacant, we'll make sure that you can continue to get your payments on time. So that's completely transparent. The loan is with our company, not with the tenant themselves. That's number 1.
So just pure promissory note type of arrangement. You promise them to pay this kind of return every month, totally hands off.
Right. Because from our standpoint, we're looking at what's going to happen after the property is completely paid off. So we'll own a property free and clear, then we would then use from that point on. We're looking 5 years down the road. That's that first model. As far as investors involved with that, they're looking to get a straight return right now. So let's say if they invest $30,000 at 12%, they would get $40,000 in payments over that 5-year period, which is, again, a pretty nice return over a period of time secured by real estate. That's number 1. Number 2, this is another method that we're spinning up right now, is for people who actually want to employ the method themselves. We will help them, and it'll be sort of like a done-for-you process. So we'll charge a fee for the purpose of helping you acquire one of these properties and getting it filled and getting everything set up, so that you can see the returns on these investments. Now, the typical return on this type of thing, or just a slow flip in general, we're targeting a minimum of 25 to 30% cash on cash returns. Minimum.
I can see that happening because you're buying very cheap.
Absolutely. Again, you're dealing with properties, you're dealing with buyers of a certain group. So you want to be able to charge a really high return in order to make sure that it works. So that's number 2. And number 3 is what I was referring to earlier as the castle project.
All right. What's the castle project? project?
The castle project came about last year. Basically, we took the time to look at this. And once I started doing these slow flip investments, and I've done 10 in the first year. So it's just looking at it and just going and going and going. It's like, okay, how do we do this at scale? How do we do more than just one at a time? So we've created this method that will allow us to, instead of trading individual properties, we're now doing entire portfolios at a time. So raising the capital in order to do 15, 20, 30 of these at a time in a way so that not only are we doing something that acquires and fills the property, but also we involve other investors as capital partners in the overall project. We've started our capital raise for our first initial pilot for 15 properties. We're targeting 2 different cities in Illinois, Decatur and Peoria, and we're raising $578,000 in order to buy 15 properties. That normally, for your typical raise, that would just be the price of one property.
Yes. You're talking about my side of town. That's like one house.
That's one house. In Massachusetts, same thing. That's not even a big house in Massachusetts. Fairly small, you can get for about 500 and change. But in places like the Midwest, you can buy 15 properties for that price point. And with that, we're offering not only just debt, but debt plus equity. So similar model as we talked about before, where we pay out over a period of time that debt, 12%. We're extending it a little bit longer because we want to just make sure that we're well capitalized over that period of time. So we're going for 6.5 years to pay off that debt. We also are adding just a stabilization period since we're doing an entire portfolio of about 6 months. So the total investment, 6.5 plus half a year would be 7. But the bonus that we get for the capital partners will be 35% equity on the overall portfolio.
When you sell, right?
We're estimating that the IRR, or the equivalent cash on cash for the entire period of time, will be around 20%. So this puts it firmly in the multifamily class of investments.
Right. I like that you buy it in the pocket because I assume you probably want to get all those cluster houses in the same area. Is that what you're looking for?
It makes it easier because we can then promote it as a buyer program that we're calling the Castle Project, where we can promote it as something where we are helping people get into their first home or getting into a home where they can buy versus just rent. And the way that we envision over time is that we will not only just have these packaged portfolios, but what we'll also do is we'll also attract some grant dollars to help people with their renovations. We'll also include things like training that will allow people to make that transition from renter to home buyer. And again, when we talk about doing this at scale, there are lots of things that we can do in addition to that in terms of doing community impact, partnering with local entities or organizations like local housing authorities in towns and cities, where we start rolling this over again and again and again. Because if we can get that kind of return, and that's what we're proving out with this pilot, we can attract more dollars to be able to do larger areas of neighborhoods and certain classes of properties that will really truly renovate and revitalize certain neighborhoods and communities in those areas.
Wow, I can see the vision of the gentrified area, certain area. They're like in transition, like the path of progression. The house still cheap enough, but it's on the way to become a up and coming area. And you go in and buy a whole bunch, and then as a portfolio, and just manage them as a portfolio to introduce that to a local community. That's such
Absolutely.
a good idea.
Now,
Yes.
remember, again, a lot of these communities, pricing has been flat for years. They have not moved because incomes haven't gone up. So you have this sort of urban type of thing, or even small towns. The property that I mentioned earlier was a small town property where it just doesn't change over long periods of time. But with something like this, if you're doing a number of these houses, which would just normally just sit, and you're turning them over and bringing in families and you're helping revitalize neighborhoods, you can make real impact in those areas. So that's the vision longer term as we're bringing capital and then seeing great returns for our investors.
I love the vision. So I imagine you have a way to find this area because you just mentioned a few city, right? So if anybody who's interested in working with you, or if they just want to go figure out if their neighborhood even fit into this kind of slow flip model, what kind of sign they should look out for to make sure that could pencil out?
I'm going to give you a website. It's called slowflipwithed.com. slowflipwithed.com. If you go to that website, I've created a slow flipper starter guide that you can download for free, absolutely free, that you can download. It gives you gives you all of the different steps and criteria and all of the different things for you to be able to answer the question in detail that you just asked. But just from a high level right now, a couple of things. First, you're looking for, again, those low price points, because those right price points allows you to be able to see really high returns. And it allows you to be able to have properties that are affordable for the people who are going to be buying them, because you want to price it about what they would normally pay for rent.
That's important, right? So you can't really have price it too higher than the rent. So that's not a good entry point to incentivize them to come in to become an owner.
Correct. Now, you can do it at a higher price point. I'm not saying that, and I know people who do slow flips at a much higher price point. It's just that you can't do it in volume at a much higher price point. You can do, just like you can flip, you can wrap properties anywhere. You can do slow flips anywhere, as long as you can find a buyer that can pay the rate that it needs to be at in order to see the kind of return that you're looking for. Now, if you're talking about the low properties, there are a lot more buyers or people who can afford something closer to rent. So that's why, again, that lower price point works really well, but you can go higher. The second thing is that you want to be in a town that's not too small. You can't go like to really rural areas, because there won't be enough of the buyer pool to really work well. So you're looking at towns that don't have to be really big cities. So you're not looking at like a Chicago or something like that, but there's a lot of other smaller second tier or even smaller than that towns that are like 20, 30,000 people or more in that starting point, where there's a sizable renter population in order to target.
20, 30,000. That sounds like a second, well, probably even tertiary town. Like,
yeah,
not
tertiary town, but it can't be just totally rural away from town, because it'll be tough to find buyers. Now, the third thing that comes into play is what happens if your property defaults. Now, for most states, particularly blue states, when you set up a contract for deed, they want to treat it like a foreclosure as opposed to a contract default. Under a foreclosure, it can take a really long time to get back that property. So to walk someone through, it can take 9, 12 months or more. And if you've only asked for a very small down payment, that's really tough.
And I think it costs about nowadays at least $3,000 to foreclose on somebody that pay the attorney fee, just minimum. You got a really good point. So blue state definitely take longer. We knew about that. Are there certain states they treat the defaults on contract for deed as a contract default? I'm sure that's the state that you're focusing.
Absolutely. So it's a contract default, and it's the time frames are much less. So usually you can go anywhere between, the shortest time frames I've seen are in states like Missouri, where they treat it just like a renter default, where it's like 30 days, they haven't paid, you can take them right to court. Wow. And usually within 45 days thereabouts, you can have the sheriff show up. That's the shortest. Now, the longer but still acceptable would be places like Illinois, where you have to give them a 90-day period. So after the 90-day period, you can take them to court. And usually it's about 4 months on the outside, 5 months, but still something within reason for that type of down payment. So it's usually somewhere in between that. But states that really make good slow flips, I mentioned Missouri, Illinois, Indiana, Ohio, Michigan is also a big place, particularly in the Detroit, Flint, Michigan areas. They have a lot of places like that. Then you also have other cities in the South, such as Tennessee, Louisiana, Mississippi. Alabama might work, but you have to make some allowances for potentially adding in a contract for deed type of vehicle, because otherwise, if it's just a straight contract for deed, they'll treat it like a foreclosure like other states as well.
I never thought about that, because I thought in my mind, just when you have to go to foreclosure, you just go to foreclosure. But I never heard about you can just treat it as a contract default and take the house back. That's a huge advantage for investor who took a risk to provide this opportunity. But every now and then you run into somebody who just stop paying. You have to kind of protect your asset.
Absolutely. And again, the asset is the contract. And if they're not paying on the contract, then just like if they stop paying their mortgage, they stop paying anything, it stops. Everything stops.
Based on what you're saying, you also have additional protection of you're not really giving out the deed, because it's contract for deed. Just like when you go out and buy a car, you don't get the title until you fully pay off the car. It's very similar idea. So that give you more control.
It does indeed. Now, you still have to record. Many of the states, but not all states, require that you at least record a memo. Like in Illinois. Yeah, you need to put a memo in that says that there are a contract that exists, but there are ways that you can set this up so that if they default, then you can then reverse it without having to go through, again, a court process as far as the owner of record is concerned and clear title.
Wow.
But states like Missouri, you don't even have to record it. just there's a contract.
I see. Well, what are the market that you're working at right now currently have portfolio that's ongoing?
So currently, I've been staying pretty much in Illinois just to really delve deeply into that market. I have one that's in Michigan. I want to broaden it out to that. Probably the next state will be Missouri. The St. Louis area has, again, tons of these properties. And these properties are not unique in any way, shape, or form in those areas. I mean, literally, there are hundreds, if not thousands now of slow flip investors who are building up massive portfolios. I know a couple of people personally that have gotten 100, 150. There's one guy that I know who has, like, imagine this, 300 slow flip properties.
Huge portfolio. You're basically sitting there collecting the mail checkbox money every month.
He has connections with lots of private money lenders, so he's been building up. But I think he's cleared, though. He has over 110 clear, where he's just collecting checks.
Yeah.
Collecting checks. No maintenance, no repairs, that just pours in every month and making literally millions of dollars on totally passive cash flow.
Almost passive, yes.
Almost
Almost.
totally,
That's
almost
pretty
totally
good. It's better than that if you ever have to own any rental portfolio, right? You either have to be fully hands-on if you have a trouble tenant, or semi-passive or almost passive. This is what I will consider as almost passive. It's like you don't even have to deal with the repair. I have property I still have to deal with repair, but they're just being set up as a traditional rental, and we're really good at screening the tenant, but even with that, it's not completely passive. So I like this strategy you're implementing. Well, I think we learned so much from you, and then we're gonna include your link in the show notes. Slow flip with Ed, right? So this is such a good strategy that I think everybody can take note on, especially for people who are busy. They have a W-2 job. Maybe there's I don't want to deal with, I don't have time to manage rental, but I can partner with somebody who has done this. And, if that's something that you're interested in, they can reach out to you. The best way to reach out to you through your website, or do you have any other social media?
Yeah, go to the website because that just makes it really easy. So either go to the slowflipwithed.com. That's slowflipwithed, just like it sounds.com, or you can go to thecastleproject.com if you're interested in the larger play where we're taking on capital partners. We've started a fractional raise. So if you're interested in learning more about that process and getting more details, more than happy to share it with your listeners and get into an individual call and just provide you all the information that you need.
Awesome. Well, thank you so much for coming up today. I learned so much from you. I think this strategy it could be a very valuable play for a lot of busy investor. They want to get in real estate, but they don't know where to start. And the best time to start and the best way to start is to start sooner, and also start with somebody who had walked the path and implemented successfully, and rinse and repeat. And then I think they can all learn so much from you. And I hope everybody who is interested in this kind of strategy, make sure you reach out to Ed at slowflipwithed.com.
Thank you so much, Cindy. It was a pleasure being on your program today.
Thank you. We'll see you on the next one.